Welcome to another Fireside Chat hosted by Credo Wealth. For those of you that don't know us, Credo is an independent wealth management business founded in 1998 with assets under advisory of over £4 billion and over 7,000 clients across the UK, South Africa, and the rest of the world. Ainsley To, head of multi-asset based here in London, and it gives me great pleasure to introduce our guest today. Ptak is Chief Ratings Officer at Morningstar Research Services. During his 19 years at Morningstar, he was also previously Global Head of Manager Research, as well as President and Chief Investment Officer of Morningstar's asset management platform. Jeff is also on the Asset Management Advisory Committee at the Securities and Exchange Commission in the US, and he's also co-host of Morningstar's popular podcast, The Long View, which is also extremely popular amongst the investment community over here. So, Jeff, welcome.
Oh, well, thanks so much for having me. It's a real privilege. I'm glad to be here.
Perfect. And where are you speaking to us from today?
Yeah, so I'm in the Chicago area, which is home, and it's also where my employer, Morningstar, is based. So yes, you find me on a very muggy summer's day here in Chicago.
Perfect. As mentioned in the intro, you spent a lot of your career at Morningstar, but you've done a number of different roles during your time there. So perhaps you can kick off by giving us a couple of minutes on sort of your background and career to date from your point of view.
I'm happy to. Yeah, so I came out of university I majored in accounting, and so I spent the earlier part of my career in public accounting, sort of banging away at the balance sheet, so to speak, auditing large publicly traded firms, and then spent some time doing research on technical accounting and auditing matters. And then as it happened, Morningstar took a chance on me back in 2002. And so I've been in a number of different research and investment management roles. Started out as a lowly manager research analyst. At that time, we were called fund analysts. Did that for a few years, spent some time covering publicly traded asset managers and global custodians, headed up our ETF research for a time. And then, as you mentioned, I shifted over to our investment management side, where I headed up one of our RIAs for 7-8 years before I had the opportunity to return back to research and head up our global manager research team, which I was privileged to be a part of earlier, and then to come back and lead it as I did was a real honor. And so I did that for until relatively recently, and have shifted over into the Chief Ratings Officer role. So really, sort of my Morningstar career is a story in sort of luck and serendipity. I've had the opportunity to do a number of interesting things with some really important advocates and great colleagues along the way, but that's been my journey.
Fantastic. Well, we're delighted to have you here to talk about your experiences in manager research and fund selection in particular. And maybe if we can start by taking a little bit of a step back and looking at the mutual fund industry as a whole. So you've obviously been analysing this sector for a while. Can you describe in your view sort of the biggest changes that you've seen during your career?
Sure. Yeah, I would say, and this will be a surprise to no one, but it's still an important and notable trend. The most enveloping development is the trend towards lower cost. I think for a while we would say it was a trend towards unbundling, and so sort of separating distribution from manufacturing, as it's called here, sort of sales from the practice of investing. That was a very, very important development, and then we've seen further bifurcations from there. But really what's happened is, the service of delivering investment management has gotten further and further atomized, atomized. It's really, sort of become more and more sort of isolated and priced accordingly. And so that's put pressure on asset managers, product providers to make sure that they're as price competitive. And as you know, we've seen a tidal wave of flows to the cheapest products. In fact, just recently, my colleagues published our annual fee study, and it showed that fees have continued to grind lower. This is a study that focuses on prevailing prices, asset weighted in the US fund market, and prices continue to grind lower in 2020. And so that just seems like an irreversible trend. Obviously, there's a zero bound, but I think that prices are going to continue to go lower because that is what the market continues to demand, given some of those shifts that I mentioned.
And in terms of looking at sort of the manager research process in particular, are there any notable trends in terms of the types of research demanded by sort of fund investors?
Yeah, it's a real good question. I would say that, one of the things that certainly changed is at one time, the demand was primarily for, and I'm speaking of kind of our core audiences and user groups, which are comprised of financial advisors, engaged individual investors, to an extent, allocators and institutions. They were really interested in sort of product research, specifically funds and ETFs. I think that one of the things that we have seen is that they're interested in strategy research that's a bit more product agnostic. And that reflects the fact that, investing has become a bit more of a buffet, if you will, where, you go and you sort of figure out what sort of capability is relevant given the goals and circumstances of your mandate. And then the product, the wrapper, is a secondary concern. So you go and shop for that manager that can fulfill that need. And once you find them, you can figure out how to wrap that in a particular legal structure. And so what that compels us to do is find ways to make sure that we can go and leverage our research and apply it to a range of different product types. And so whereas once we focused on mutual funds and ETFs exclusively, now you've seen us range into other areas like separately managed accounts, model portfolios. And I think that you'll see sort of us range into other universes that we don't cover today, sort of in that same direction of travel that we've been on. So that's been a pretty salient development in the way we look at managers. And then I think that there's been, I would like to think it's been a further professionalization of the research that we do. At one time, I think, if we're honest with ourselves as manager researchers and selectors, performance did have a certain primacy, and it's sort of permeating in your process, whether you want it to be or not. And I think that we've tried to take some common sense steps to make sure that performance informs doesn't govern the way we're assessing managers. And we're spending the bulk of our time trying to evaluate the things that we think are going to be most predictive, I should say, of future outcomes, which are people, process, and then the parent firm that oversees the product set that we're evaluating at that time. So those are, sort of product agnosticism, strategy centricity, and then further professionalization of the evaluation process. I think those are notable developments over the last certainly decade.
Yes, very interesting. And
the other thing, I should have mentioned it before, and I'm so sorry. It's amazing that I didn't cover this given how long-winded that answer was. But, the other thing that I think is a noteworthy change is the fact that our clients, our users, they define success differently than they once did. And I think that probably the signal example of that would be sustainable investing, which has become a flagship initiative for the firm and our researchers as well. In that case, they have a more encompassing definition of success than excess return or alpha or the number of stars that we put next to a product that they've invested in. What they might be interested is best practices in or I should say, how well a product upholds best practices for E, S, or G, or all three of them together. And so, again, that's a pretty noteworthy development in sort of what is being demanded of us as manager researchers, and we're trying to make sure that we're equal to the task.
No, and certainly in terms of the skills required for manager research have broadened, and then probably will continue to do so as
that's right.
Different demands. So diving into some of the research that the Morningstar puts out, one very interesting report you guys call Mind the Gap, which refers to a phenomenon known as the behavior gap. Maybe you can describe for our audience what the behavior gap is and when looking at a fund and how you measure it.
I'm happy to, and that's a really timely question because we're actually about to publish our basically it'll be we put it out annually, so this will be our update covering the year 2020, basically the 10 years ended December 31st, 2020. And to quickly summarize what Mind the Gap looks at, it basically looks at the difference between dollar-weighted returns, which, internal rate of return is another term that's used for it, and then the total returns of the fund. And why might the two be different? It really boils down to the timing and magnitude of cash flows into a product at a given point in time. And so Mind the Gap is basically sort of the stamp that we've put on this brand of research, looking at how opportunely investors have made use of their funds. We can certainly focus, and many of us do as a practical matter, funds total returns. But as we know, what really matters when it comes down to it is what portion of that return investors are able to actually capture, because that's ultimately what matters to them achieving their goals and, basically achieving a positive outcome, we hope, in investing in that product. And so we feel like it's a salient bit of research. It's something that we've been doing for a while now. My colleague, Russ Kinnell, who chairs our North America ratings committee, he's really the person who pioneered this study for us and has done a fantastic job. Now my colleague Amy Arnott is running it. She'll publish the most recent study, and we'll look forward to sharing the results. What we have tended to find is that there is a gap, which basically means that investors are not capturing all of their funds' returns. And how do we close the gap? I mean, that's been something that we've been focused on, and we can spend a bit of time talking about that. But really what you're trying to do is instill discipline and patience amongst investors, because we think that's one of the ways in which they can capture more of their funds' total returns than if they're to try to sort of slalom around the market and chase performance.
So generally speaking, in the sport, you note that the investor return, the end investor in a fund has a much lower return than the fund itself. And then in terms of causality, have you managed to find any main reasons for that?
Yep. So the chief culprit will be investors who are chasing performance. And so in a situation where they buy high and sell low, their dollar weighted returns are going to meaningfully lag the fund's total returns, because they're going to come in late and then the fund is going to roll over, and then they're going to sell at the bottom. I mean, that's the worst case scenario. And unfortunately, we see that happen, especially with products that are more volatile, maybe are more narrow or thematic. They have a certain kind of sex appeal or curb appeal to them, but they're very, very difficult for investors to handle, our research has found. And so that's where you find the widest, I would say, gaps, is with those more volatile or narrow products. And then the flip side of that is products which are a little bit easier for investors to use. And those tend to be all-in-one products that are very, very widely diversified and then automate key features, like, for instance, rebalancing between asset classes and even the glide path. So in the case of a target date fund, which, as you know, is a very, very popular category of funds, of products here in the United States, the glide path basically dictates the mix of assets over time while the investor holds it. And so it further automates the experience for the investor. And what our research has found is that they generally do a better job of investing in those, just because they don't really take action. They invest in them and then they leave it alone. And in this case, leaving it alone is a good way to capture more of your fund's total return, our research has found.
So is it fair to say that in terms of disaggregating solutions versus products, those are more solution-like, that's an investor's just holding for the long term, has had a smaller gap than maybe a building block in sort of a broader portfolio?
Yep, that's a great question. And yes, our research has found that. And so, when we look at multi-asset, so we basically, when we conduct the Mind the Gap study, we can break it down in a variety of ways, one of which is category group. And one of those category groups is allocation, which is essentially multi-asset. And what you tend to find is that the gaps there are narrowest. And then on the flip side, we have sector groups category groups like sector equity and alternatives. And what our research has found is that those products tend to have the widest gaps. And so it's quite interesting. There's been a lot of attention paid to, things like thematic products, sector-oriented products. And some of those have delivered outsized returns, and that's what's garnered them the interest from investors and some of the notoriety that they have achieved in the media and elsewhere. But what you find, unfortunately, is that investors, because they don't time their investments into those types of products opportunely, they capture on a dollar weighted basis the same kind of return that they would have earned if they had just put their money into U.S. multi-asset funds. So basically, that total return advantage that you would see between sector, thematic, and multi-asset, I mean, the sector and thematic have handily outpaced multi-asset just because they've been exposed to some of the most successful themes and areas in the last decade or so. but investors through poor timing have frittered away those advantages. And so basically what they get is the volatility of a thematic product, but the same dollar weighted return that they would have had in a less volatile multi-asset product. That's what our research has found. And that's one of the reasons why we think it's important to continue to highlight this area.
And just in terms of timing, generally, whether it's into sort of traditional active funds, into thematic sort of index-based funds, or sort of very, very traditional passive funds, have you seen any difference in ability to time between those, or maybe your sort of personal views on that?
So it's quite controversial in a sense. I think that, those who are proponents of active funds take great umbrage when you suggest that people do a better job of investing on a dollar weighted basis in passive products. And I think they actually have a point insofar as what our research has found is it doesn't depend quite so much on whether it's active or passive as the context in which that investment is used. And so I think what you might see more often with a passive product, and I'm speaking of sort of like a cap weighted, widely diversified sort of beta product, if you will, as opposed to like some smart beta, this or that, that's much, much narrower. I'm talking about like the most, sort of the broadest types of products. Those tend to be part of solutions, as you know. Maybe they're used to try to execute an investment plan, right? And they're paired with other very broad products. And the idea is to provide the exposure to the market and then find value elsewhere as part of maybe the financial advisory program that they're a part of. And so by virtue of that, they're not going to tinker with it as much, and they're going to probably stick with it through thick and thin. Whereas I think when you have these standalone nichier products, especially when they've got some of that curb appeal to them, I think that tinkering goes on, and oftentimes those products are active, not always, but many times they are. And so I think that can lead to less than optimal results and wider gaps in those cases. But it is nuanced, and I would not suggest that, you're going to see a smaller gap if you invest in a passive product, because that in and of itself is not going to guarantee that you're going to use it wisely. There can be other factors that intrude that, cause you to chase performance and basically have a big gap there. And conversely, you might use an active fund very, very prudently and capture most of its total return. So I think it's more about context than it is the product type.
How the tool's used as opposed to the
exactly
tool itself.
That's right.
Perfect. And just onto sort of another area of research, and maybe you can explain for our audience what Dunn's law is, and some of the insights there.
I'm happy to. And so what Dunn's law holds is essentially, the way to think about Dunn's law is, let's suppose that we're talking about an investment style. And you've got a bunch of different strategies that implement that investment style. And so I'm here in the US, and one of the most popular category of strategies would be US large cap. And so as we know, we've got a number of active funds that are out there, and they're going to invest primarily in the stocks of large capitalization companies. Their indexes are going to invest exclusively in large capitalization companies. But let's go back to those active managers. I said primarily large capitalization companies. It's also possible that they will hold the stocks of mid caps and even small caps. And so basically what it means is that they tend to be a little less style pure, or that is, they're a little messier than their indexes. And so what does that mean? It basically means in a situation in which that style is in favor, the index is going to be more difficult for the active funds to beat. Why is that? It's because it's got a more unadulterated exposure to that style. In this case, it's large cap stocks. And then conversely, in situations in which that style is out of favor, let's imagine that mid and small cap stocks are ruling the roost, then it's going to tend to advantage those active managers. And why is that? It's because they are more exposed to those styles. And this is what active funds do. They're going to change the weightings of the stocks that comprise an index, and then they're going to go outside the index. And so that means that they're going to be less style pure than their index. And so what Dunn's law holds is that in many cases, when we see these divergences of active funds from the benchmark that represents their style, it's often explained by these stylistic differences and what's leading, what's lagging. And, you know, it's something that I've tended to cite in my work, just because I think that, you know, we can go and form narratives around what it is we're seeing. You know, this manager is leading, this one is lagging, therefore that first manager is a hero, and this other manager is a goat. And really what is often happening is sort of stylistic cross currents explaining why it is the manager is leading or another one is lagging. And it's just important to sort of place it in a broader stylistic context. And I think if you can do that, then you can make, I think, more prudent judgments, and certainly be more patient through a market cycle and make better use of an active strategy, certainly, than perhaps you otherwise could. So that's kind of what Dunn's law is. It's just sort of understanding what the different stylistic exposures are in products, how that compares to the benchmark that they're compared to, and then after reconciling those differences, trying to explain some of the performance differences that you're seeing.
Yeah, no, I found that sort of area of research very interesting. And then one of the implications I took from it, from a multi-manager sort of context, is that if you're separating your asset allocation process from your fund selection, so for example, you're overweighting or underweighting different categories based on your view of the expected returns of that category, but then afterwards you're implementing that asset allocation by selecting active managers within those categories. That's sort of where the messy exposure of active management becomes a problem.
Exactly.
So for example, if I choose to overweight US large cap growth because I think that category will outperform, but the active managers in that sector underperform when US large cap growth is beating the other sectors, then what I gained from my correct category call, I might lose on the fund selection side. Which was, I just found quite interesting because, separating those two decisions.
You're exactly right. You're exactly right. And I mean, I think that's one of the reasons, like it or not, that allocators have become more and more fond of passive products, just because I think it's one less moving part for them to deal with. They put on exposure. They don't really have to worry about the tracking error of their managers. And sort of Dunn's law coming into play, or wondering whether something is simply attributable to style versus skill. They just put on the beta and implement their allocation that way. And it's one less thing to worry about. We know that there are many, many skilled active investors who are out there. And we know that they will continue to confer good outcomes to investors and beat their benchmarks, and allocators will benefit from that. But I think as a practical matter, there are a number of allocators that are out there, advisors and individuals for that matter, who are just basically deciding that, simpler is better. And so they, for the reason that you've noted, they decide that they'll just implement with passive.
Perfect. Yeah, and then moving on to sort of the active and passive, and then of course, as you mentioned already, we have to be careful with the definitions. But one thing I thought was quite interesting when looking at what we think of as active, which is traditional active managers, not including sort of factor exposures, etc., is that all the literature on the mutual fund side and mutual fund performance spanning many decades sort of concludes that it's obviously very hard to beat the market for many mutual funds, whereas if we're looking at the security side in terms of the academic literature on asset pricing, so looking at the cross-section of returns across individual securities, a lot of the research, such as equity factors, for example, looking at that research, suggests that there are many investment strategies that do beat just the cap-weighted exposure to the market. So you studied many managers and probably seen a lot of things that academics would never be able to take into account in sort of broad studies. How do you reconcile the differences there? Why have so few mutual funds been able to beat the market, and yet in academia there are a lot of known factors that beat the market?
Yeah, no, it's a great question. I think that as a practical matter, I don't think that fund managers have always done the most sort of realistic job of pricing their products. I think that's been especially true over the last 10 to 15 years. The game has changed. I think that there's been, excellent research that folks like Michael Mauboussin have done that show that through the professionalization of investors in the markets, sorry, this is my dog sort of getting restless in the background here. Through the professionalization of investing, things like the standard deviation of pre-fee alphas or information ratios that, basically that's gotten narrower and narrower. And what that basically means is that, investors collectively have gotten more skilled. And in turn, what that means is that there's less alpha for active managers to capture before fees. And there can be a number of different reasons. I said professionalization of investing, the dissemination of information is another one, gains in sort of trading and operations. I mean, these are all reasons why you can see this grinding away of alphas that might have previously been available. And what hasn't happened is you haven't seen prices come down as rapidly as they need to come down. And so as a practical matter, what you find is that a lot of these funds, not all of them, but a lot of these funds just after fees are baked in, they can't keep up with their benchmarks. And so that's why it's pretty typical to see over, say, a 3-year cycle. I'm focusing on the US. It's 20 to 40% of the active funds that we would be tracking, if that over a 3-year period of time, in aggregate, are going to be beating their benchmarks. And that's it, academic literature aside. So it's the difference between theory and practice, pre-fee and post-fee, and then taking into account developments in the market, which, if anything, have made it more difficult for active to succeed in certain areas, particularly in equities.
And you mentioned you spend a little bit of time on in terms of equity research on that side and looking at individual securities. So again, sort of a little bit of a theoretical question, but in terms of one of the predominant views of why in terms of mutual funds, why they underperform the market, as you mentioned, is this market efficiency element, and that prices are incorporating enough information that there's not enough left for managers to profit. But at the same time, when you look at the assets within the mutual fund industry and the amount of AUM allocated to funds that aren't necessarily expected to outperform, it maybe suggests that the mutual fund market is not as efficient as the stock market, at least when we're talking about equities. I don't know whether that's in terms of observations of investors in mutual funds, whether that's something you've observed in terms of are there enough frictions that make the mutual fund market so inefficient if there's such a misallocation of capital there, or are we looking at it the wrong way in that sense?
No, I think that's a fair point. I think that one of the idiosyncrasies of a fund market, and this is true of the U.S., is distribution, sales, and how intermediated it has been. And I think for quite some time, you basically had a lot of flow going to funds that maybe weren't necessarily worthy in some ways, but had forged relationships that were important and that basically ensured that they received flows of money. I think that this has largely reversed itself over the last decade plus, but I think that, when we're talking about the 90s and the early parts of the aughts, I think that sort of distribution complex was still alive and well, and it funneled a lot of money towards funds, and it remains in some of these funds in certain cases, that just didn't really necessarily have the chops to deliver the alpha at the end of the day when you took their fees into account. And so, the industry has been sort of working this off. I don't want to sort of paint a picture that, you've got, trillions and trillions of dollars that is sitting with totally unworthy, unskilled managers. I think that there's, a number of high quality funds, and we've got high ratings on them that I think are deserving of their investors' confidence. But I think, to your point, there's a number of other funds where, it's a bit of a remnant of a previous era where I think that sort of the power of the narrative and some of the relationships that you forge explains why they have the assets that they have. And I think the market has been working to correct that over the last decade plus, when you've seen lots of money flow out of some of these products and into index products. But, again, it's sort of the realities of how, sort of the business of running money, how it works. And it's maybe a bit less forgiving than an academic study would suggest.
Yeah, that makes sense. Perfect. So we talked a little bit about the industry. Maybe I'd like to zoom in from the industry level down to individual managers and your thought process for assessing them.
Sure.
And you touched on a few of the points. But the first thing that most investors tend to look at is returns of a fund or a manager. How relevant is past performance data, and what are the right and wrong ways to use it for manager selection?
Sure, that's a real good question. Yes, I mean, I think that performance can be informative. I think it's very, very important to place it in an appropriate context within the overall research process. And that can start with sort of how you sequence that process. I mean, I think that if you're running screens and it's based on performance, that's pretty much going to guarantee that performance is going to play a very, very influential role in your decision making and monitoring process. I mean, it's just inescapable. Whereas I think that if you are to sort of widen the aperture a little bit and start with the question of, okay, what is it we're trying to achieve here? What kind of exposure are we looking to put on? What are sort of the characteristics of this area that we're looking to invest in? If we look at it, how efficient or inefficient has it been, and why maybe has it been that way? Let's suppose it's inefficient. For instance, we see a very wide gradient of returns amongst the different funds that are within that space or invest in that style. How exploitable are some of the opportunities that we see there? And then, based on that, what are some of the attributes of a manager that you have seen go in and exploit some of those opportunities in these areas where you think there are exploitable opportunities? To me, that's a much more sort of useful progression track to go down than, let's put on a 3-year performance screen and whoever's in the top quartile will start diligencing them. I mean, at that point, really sort of people, process, and parent, those are very sort of cosmetic parts of the evaluation process, because performance has gotten you at least 3/4 of the way there. And so I think if you can invert things slightly so that performance plays that supportive rather than dominant role in the process, then I think you can make a more considered judgment about whether a manager is relevant to what you're trying to do, let alone has the capabilities to deliver that to your investors over time. And so that's kind of the way we've come to think about performance as part of our process. And that's why we've made the evaluation of people and process and parent, those are sort of the overarching, or I should say the organizing principles for the research that our colleagues conduct. And I should mention, you're being very kind in letting me speak to it, but we have a really great team here, led by Lee Davidson. He heads up our global manager research and quantitative research team. And he's got a number of lieutenants who report to them throughout the world that do just a fantastic job day to day of diligencing managers. And so really, I'm describing the process that they follow and doing the great work that they do.
Perfect. And I'm sure we'll come on to sort of manager meetings and some of the nuances in the qualitative research. But you mentioned some of the 3 Ps there, and maybe for just quickly for some for many retail investors, they only have access to generic information and may not have necessarily either the skill set or the access to do some detailed due diligence. So maybe if we can do a quick sort of lightning round of I'll give you some headline fun information. You can let me know so just a couple of quick thoughts on each, whether it's relevant or not, or whether they might be useful. So, for example, for an investor looking at total expense ratio of a fund, how relevant is that?
I think it's extremely relevant, and that actually would be the first place I start, is looking at the expense ratio of the product that you're looking at. It's absolutely true that there can be cheap products that are terrible and expensive products that are worthy. But generally speaking, I think that the expense ratio is something that you can use to tilt the odds in your favor. And so if you had to start with a thing for your search within a particular style, category, what have you, I would look at fees. And that's, I realize, going to be an unpopular view in some quarters where people are like, oh, come on. It's about what you get after fees. You can't make that your starting point. Our research has found that fees are one of the most predictive, if not the most predictive, variables that someone can focus on. And so I think that for the average investor who wants to tilt the odds in their favor, that is a great place to start. I think it also does tell you something in subtle ways about the firm. I think it can tell you how it is they think about the investment process, how realistic they are. It also can tell you how it is they approach the market. What is sort of the fiber of this firm? Who do they do business with? And basically, when you look at the expense ratio and get a sense of what packed in there, what share class is made available to you, why are you getting that share class, who else are they selling to, it can just give you a sense of the overall orientation of the firm. So it's another reason to focus on fees. So that's that's an important place to start. I would also certainly look at things like turnover rate, and I'm speaking about equity strategies here. When I've talked about diligencing managers, I think I've said before that a turnover rate, to me, that can be really, really telling. Again, it doesn't evidence skill. It doesn't necessarily predict whether you're going to have a good experience or outcome in a product. I just think it can be revealing about what kind of culture, is it very, very sort of research intensive, impatient? I mean, the turnover ratio can actually tell you quite a bit about that just at a glance and allow you to dig in a little bit more. So that's a process oriented evaluation that, I think you can use with, a pinpoint data point like turnover ratio. That's something that I would focus on. Within people, I would certainly look at the tenure of the managers that are involved, how many managers there are, and sort of whether there's any sort of pecking order as far as you can tell, sort of a manager history and seeing whether there's been frequent changes over time. Again, that's something that can be revealing, not just with respect to the strategy, but also how that firm is wired and what kind of job they have done of sticking with strategies through thick and thin, and with managers that are running those strategies through thick and thin. One of the things that we know is that career risk can be quite hazardous. And basically, career risk is this notion that, managers are, they're afraid that they're going to get fired. And so they're running scared, basically in the way they run money. And so they'll hug their benchmarks and they'll chase performance, and they won't be the kind of sort of courageous investor that they need to be to succeed in the market long term. And so if you see there's a history with a fund of managers cycling in and out, it might suggest that, yeah, they are worried about their jobs because this is a firm that has a history of swapping out managers on a frequent basis. So that manager tenure is another thing that I would look at. And then the last thing is, I think with respect to parent, big firms, boutiques, I think that, organizations have proven that both of those models can work, but there are trade-offs associated with each. So I would just try, like, if you are looking at a fund, try to learn about the family. How many strategies do they offer? What seems to be sort of their core expertise or focus? Do they look like they want to be sort of, sort of the masters of all these different disciplines, or do they tend to niche and focus? That also can be revealing. That's kind of the set of progressions that I would go through if I just had sort of the filings or publicly available information available and I couldn't talk to the manager. Those are the kinds of things that I would probably focus on.
Perfect. Yeah, no, and you hit almost on my list, so that's great. And maybe focusing on the metric side as well. So Morningstar launched their quantitative ratings a few years ago, which are driven by machine learning. Can you describe these ratings for our audience and how they're put together?
Yeah, I'm happy to. Yeah, so back in, it was 2017, our colleagues in our quantitative research area, and so these are very, very skilled quantitative researchers, data scientists. They built a model. It's a machine learning model. And essentially the way to think of this model is it is trying to emulate the rating setting practices of human analysts like myself and my colleagues here. So essentially what the algorithm is attempting to do is look at the universe of rated funds, that is, funds that have been evaluated by analysts, the attributes of those funds and the ratings that the analysts have assigned to those funds. And based on those learnings and the inferences the algorithm draws based on those relationships, it can go and apply those learnings to funds that our analysts don't cover. And essentially in so doing, they can make a quantitative evaluation, a forward-looking evaluation, a quantitative evaluation that mimics the way a human analyst would assign a rating to that fund if they were to cover it. And so really it's designed to work in tandem with the ratings that our human analysts assign. So it's known as the quantitative rating for funds, and it sits alongside the Morningstar analyst rating. The Morningstar analyst rating is the rating that our analysts assign to funds and other managed investment products that they evaluate based on the merits of the product that they're evaluating. But that's what the quant rating is.
And with the machine learning, as with many data-driven exercises, a lot of it depends on the inputs that you're feeding. So how do you decide which inputs go into the quant ratings?
Yep. And so our colleagues on the quantitative side have done a very comprehensive sweep of the different data points that are available to us for all the funds that we cover, and their relationship to essentially the evaluations that the analysts are making. And so just to maybe back up a second here. So when our analysts are doing their work, they're not only assigning a headline rating, which takes the form of gold, silver, bronze, neutral, or negative, but also pillar ratings. And so I mentioned before people, process, and parent. For each one of those areas, there's a pillar rating that they assign, which takes the form of high above average, average below average, and low. And so essentially what that gives the algorithm is information that it can use. And so it will look at, for instance, below average people parent ratings. What is the relationship between that and, say, maybe the average tenure of the manager that's on that fund, which is a data point that we collect. Also, as you can imagine, we're looking at price, and that's an input into the model, and that can feed into either process or parent, and so to performance. We try to make sure that performance is not something that's driving the model, because that's not the way our analysts are approaching their work. But certainly performance can play a role. And so that's another type of input, in addition to other measures like turnover ratio, the number of funds that have been launched or merged away over some period of time, and a myriad of other data points. Essentially, our analysts, you can sort of think of it as a vacuum cleaner. Our quantitative analysts are taking all of those different data inputs, sucking them in, comparing them to the assessments that our analysts have made, looking at the relationships between those, and then drawing inferences based on that in terms of sort of like the strength of those relationships in deciding what to include in our quantitative model that ultimately spits out the quantitative rating that we assign to funds that our analysts aren't covering. And I should mention that, for each one of our primary rating systems, we've been talking about the Morningstar analyst rating as well as the quantitative rating. There are methodology documents that are publicly available that we post to our website, and that would list off, in the case of the quantitative rating, the different variables and inputs that go into it and determine what the rating's going to be.
And from memory, the algorithm that was chosen that you guys used was random forest, and it's one of the advantages. It's somewhat more interpretable than some of the other machine learning techniques out there. So, are there any? Is there anything about the process and the way the inputs are flowed through, maybe the weighting that it's putting on different variables that surprised you, versus the qualitative process that the analysts use?
Yeah, and so this is where the art and science comes in. I think that there would be some variables that maybe would feed into things like people or process that you wouldn't immediately associate as an analyst with people and process. But I think that part of the value of a quantitative routine like random forest is, it can be revealing about analyst tendencies. We only publish, I should say, we will publish a quant rating or an analyst rating for a fund, but not both. And the reason for that is we want to make sure that we don't confuse the algorithm, and that the algorithm doesn't confuse the analysts. But all the same, we can learn from the algorithm insofar as it's finding relationships between certain variables and certain of our pillars that we wouldn't normally associate as human analysts. And that might tell us that we're maybe a little bit more focused on performance than perhaps, we would have assumed, or, something that we think that we take into account as human analysts, maybe really isn't as big of a weight when it comes to the random forest model and the weighted accords do it as part of the quant model. And so I'd say it's been revealing in that sense. And also they retrain the model on a periodic basis and to see changes there, that can also give you a sense of maybe what it is the analysts have been paying more or less attention to as they go through their work. And that can be something that feeds into the work that we do, so that we're a little bit more cognizant of that as we're doing our diligence on managers.
Perfect. And in terms of I guess we'll come on to manager meetings in a second, but you mentioned sort of the art versus the science, if you like. On the investment due diligence side, is there anything from your personal experience that you found as tended to be contradictory or maybe opposed to some of the broad academic findings within sort of manager selection?
So I think that, and I'm guilty of this, maybe more guilty of this than any manager, researcher, or investor out there. I think that we underestimate how perishable things are. And, like the first place you would go is sort of like excess returns or skill or measures thereof, and how those decay over time. And one of the reasons that happens is because investors love a strategy to death. It has some success, they pour assets in, and that changes the way that investor approaches things because he or she can't do it in the same way they did before. That's one of the most common reasons why you see decay or perishability in investment strategies. And I think that we do have a tendency to underestimate that, but it also extends to sort of people issues, organizational issues. Sometimes you have folks that lose their focus and their fire, and they're human beings. And that's part of the beauty of this business, is that, you're basically you're harnessing the intuition, skill, of these human beings, and basically achieving an outcome that might not have been possible otherwise without that. By the same token, the flip side of that is these are people that have their own set of imperatives and circumstances, and things can change in very, very unexpected ways. And I think that's even truer of organizations as their priorities and imperatives shift around. That can have a real profound impact on the way they invest, or I should say their portfolio managers invest as part of that organization. You think of things like fund mergers, which have, I would say, at best, a very checkered track record in the fund industry. Those are the sorts of things that can happen and really throw a wrench into the works and have a big impact on sort of who's going to be calling the shots there and how focused they're going to be on delivering good outcomes to investors. So I would say that just as I've, been sort of exposed to this more and more, I'd like to think I've become sort of more humble about those aspects of it and less certain in my views. And I think that's probably a good mindset for us all to have as we're approaching manager diligence.
Yeah. And then I guess in terms of all the formal attribution techniques and being able to dissect performance, it's one thing looking at what has happened and being able to find some interesting insights about that past period, but obviously it's another thing then using that for prediction about which funds are going to outperform in the future and then what's going to drive those returns.
No, I think that's quite right. That's quite right. I think that the more you can get in and sort of decompose things, break it into smaller pieces. Performance attribution, you mentioned, that's one of the ways in which we can do that, but even focusing on sort of the squishier aspects of manager diligence, sort of understanding what the component parts of a strategy are and how maybe that's contributed to its success or, the struggles it's had recently. It just helps you to sort of place things into a broader context and make, I think, a better, more patient decision about, whether to continue with it or to look for another strategy. My personal philosophy is, less is way more. Try to, and this is another area or maybe viewpoint where, I think maybe it won't be positively received by some of the folks that are watching this, but I think there's real value in trying to minimize the number of decisions that you're making, make as few decisions as possible. And that doesn't mean that you're inert, you're doing nothing. But I think that if you can put yourself in a position where you don't have to make as many future decisions because you've been more thoughtful about what your expectations are, how those apply to the manager that you're diligencing, and then basically evaluate them per those standards. It obviates the need for you to make future decisions. And I think the fewer decisions you make, the better off you're going to be, which is kind of like, it brings us full circle back to that mind the gap, the behavior gap that we were talking about earlier, these timing gaps that investors experience. I mean, I think that one of the things that you observe when you look at that study, is, year in and year out, the way we do, when investors put themselves in situations where they have to make more decisions, they're going to get themselves into more trouble, and they're going to have more timing gaps, and they're not going to capture as much return as they could otherwise. And so I think that should inform our approach when it comes to diligencing managers. Try and put yourself in a position through a process that you've implemented where you don't have to make as many of those decisions and as many of those changes in the future. I think that's a good thing to aspire towards.
No, certainly that resonates a lot with my views on it. So we've spoken a little bit about the hard data and the sort of the science side, and now I did want to shift to the manager meetings in particular, which is obviously where you gather a lot of the qualitative information that maybe you can't glean from returns or holdings data. So maybe we start off with when are managing meetings important in your view, and also what do you look to gain that you can't from just sort of pure desk research?
Yeah, no, great questions. I guess I would start by saying that, and this is another, even my colleagues strongly disagree with me on this. I do tend to think that manager meetings are a bit overrated. I think that they're an important part of an evaluation process, but they're not absolutely essential. And I think the way they're often conducted in practice is suboptimal. Like going into a manager meeting and being like, okay, what's changed at your firm? And, oh, I see you traded this, you bought this and you exited that. To me, that is not a very fruitful use of time. And I don't know that that's necessarily going to yield a lot of insights that are going to help you to make a great judgment about whether to continue allocating to this manager or to take a different decision. So that's what I mean by manager meetings can be overrated. Where are they most essential? I mean, as a practical matter, I would say the more opaque a strategy is, or the more complex a strategy is, the more important it becomes to have access to a decision maker. Just because, as you've already alluded to, there's limits from the information. I mean, like I think of some of these liquid alternative strategies that I look at, and I look at, sort of like annual reports and semi-annuals and what have you all the time. And I look at these things and I have no idea what is going on. It's like, it's hopeless for somebody that doesn't have access to the manager. I think in many of those cases, they're not worth allocating to anyways. But my point is, in some of these situations, it can be quite helpful to talk to the managers just to sort of unpack what it is you're seeing there and why they're allocating to it, and what are the risk return attributes of the individual securities in isolation and in combination that explains why you're seeing them in the ledger the way you are. And it doesn't always have to be exotica that we're talking about, alternative strategies or what have you. It could be fixed income strategies, right? I mean, fixed income is, it's not sort of complicated. We know what a bond is, but there's a dizzying variety of these securities. And then when you're talking about sort of the three dimensions of portfolio management and how it is a fixed income manager is bringing all these securities into a portfolio, it can be really useful to talk to them and sort of pick their brain. The data and analytics around fixed income are not always where they ought to be, depending on what you have access to. And so I think that makes it even more potentially valuable to talk to fixed income managers. Where is it less valuable? I mean, long only equity in a lot of situations. I don't know that it's necessarily essential to have a manager meeting, but it can be helpful to have those manager meetings, and we do consider it a privilege to have those opportunities the way we have amongst our manager researchers here at Morningstar in talking to managers. So we're very grateful for the access that we get. We hope we continue to get it, but I'm just trying to illustrate that there's sort of a spectrum of value that you have in manager meetings. And I don't know if you wanted to talk about sort of like how it is one should approach a conversation with a manager based on the experiences that we've had, but I'm happy to speak to that as well.
No, absolutely. Yeah. And you mentioned there are elements which are maybe overrated, but also any elements with the crucial parts of management meeting, maybe, for example, something that would be a deal breaker that you'd hear in a meeting that would override a lot of the desk research you've done.
So I would say that, something that would be conspicuous by its absence, if I went through a manager meeting and I didn't have a real good sense of, decision accountability, who owns decisions, how are decisions made? And I'm not suggesting that this always is going to be crystal clear. You can have, multi-manager systems where you've got a number of different portfolio managers who are collaborating, each of them with different roles and responsibilities or areas of expertise. That's not going to always, be a single slide in a PowerPoint or a quick soundbite in a manager meeting. It's going to be a more distributed system. But I think if I came away from a manager meeting, it was just like, holy cow, I have no idea how they make decisions here, who is accountable for what. That's a red flag. You don't want to come away from a manager meeting with that kind of feeling. The other thing that I would say, it's a little bit corny, but I wrote a piece a few years back where I suggested it can be valuable to ask a manager to work backwards. And what I mean by that is the manager should be able to clearly articulate what their excess return goal is. And so there's a very simple arithmetic behind that. You're going to go to a product that's going to have an expense ratio on it. One hopes that their excess return target exceeds the expense ratio. Otherwise, we're all wasting our time there. Once they can articulate that, and you'd be surprised how unequipped or loath some portfolio managers are to do that. But once they articulate that, it can be really revealing to have them work backwards from that. So let's say, okay, I think I can do 2% per annum pre-fee in this strategy that I have, and maybe I price it at 75 basis points. And so you've got basically, an excess net return of, positive, what's it, 1.25, 125 basis points per annum. Okay, so kind of work back from that. How do you get that 2%? Where's it going to come from? Maybe it's a long only equity strategy. 2% is not a small number. So where is that coming from? How are you getting the mispricings that you're going to need in order to get that 2% per annum pre-fee? I think that can be, a pretty revealing conversation to have with a manager, especially on first conversation. And if you can't really come away with, a kind of a cogent sort of explanation of how it is they're getting to that, again, that's a bit of a red flag. And conversely, if you come away from that meeting like they have a really sort of ordered sense of how it is they're going to add value, then that's a good fact. That's going to buttress your confidence that sort of their system of running money has been well thought through, and that they can implement it in a way that actually it does have a chance of delivering a positive outcome over time.
And we touched on previously in terms of some of the behavioral factors for a manager, and assessing, the way they approach decisions, etc. Maybe you can talk about how are there any techniques you use to gauge that during a meeting?
Just in terms of sort of like, are they following what they're saying they're doing? So go ahead.
I guess the examples I used were for when you think about maybe managers who aren't necessarily as prone to changing their mind when provided with new information, or who aren't necessarily as focused on what their edge is, or are less aware of what their edge is. Things that Michael Moverson may have talked about as well in terms of decision making, and especially when faced with uncertainty, and how you assess that and the soft qualities there.
Yeah, no. So I think it makes a lot of sense to go into a conversation, sort of thinking about, I want to define what this manager's true capability and expertise is, and so really, talking to them about that. You're a long only equity manager. Obviously, it goes without saying that you're going to try and go and beat your benchmark. How are you going to do that? What's your investment style? What evidence is that in the portfolio? Give me some examples of that. And then if they give you an example of a security, really tying back to some of the things that they said earlier in the conversation about, here's what we think we're really good at. I mean, I think it can be really, really worthwhile in a conversation, when you're talking to a manager, to ask them to explain to you why the market is mispricing a security that they think, stands to deliver outsized returns to them. I mean, is the story misunderstood? Is there something about the way this firm is organized that defies the understanding of the market and doesn't command the kind of multiple that you think it commands? How could you be wrong? And to what extent have you built in a margin of safety for your investment? And what was that price that reflected the margin of safety requirement that you've imposed for this? And how has that changed over time as your understanding of this name has evolved? Those are all ways, I think, in which you can cement your sort of confidence that the manager's articulated investment approach really ties back to the portfolio, not just at that point in time, but over time. And so those are the kinds of sort of questions that you probably want to be mindful of if you have the opportunity to talk to a manager, and basically take their measure.
Mm. And I would like to spend a moment on what I feel is maybe one of the most difficult parts within manager research, and really that's sort of the trade-off between sort of star drift but adapting to changing sort of market environment. So how do you feel the balance between that necessary adaptation versus someone who's just simply sort of changing his process for maybe the wrong reasons?
Yeah, I think that's a real good term you use there, necessary adaptation. I think that there definitely needs to be room for that in a diligence process. I think that if we're too literal about our interpretation of style and sort of conformance to a particular style as we've defined it, I think that we basically are denying ourselves one facet of value that an investor can deliver, an active investor can deliver to us, which is recognizing that circumstances change, premia change, and so there are opportunities to stick within your investment discipline, which may have a certain opportunistic streak to it, and exploit opportunities that don't strictly conform to a style as you've defined it. And there are a number of managers that we followed over the years that that we strongly recommend, that sort of that's their calling card. They don't have this sort of very kind of cookie cutter definition of value, let's say. It's sort of it's a malleable definition of value, and I think that's fine. It's especially timely right now because some of the best money that's been made is in what look like proto growth firms. These were firms that just were not making money on a P&L, but they threw off lots of cash, or they were endowed with other competitive advantages, which down the road were going to generate gobs and gobs and gobs of cash flow and therefore value. And there were some value investors that recognized it, even though they sat in the right-hand column of the style box. And so I think that there absolutely should be room to give the PM some room and not be so literal about sort of their adherence to a style that we've defined.
Balance between consistency versus,
that's right,
learning that value. Jeff, this has been a wonderful conversation, and I would also encourage a lot of our viewers to follow you on Twitter. You always have some very interesting insights and very engaging. So maybe you could share your Twitter handle, also where investors can find you.
Yeah, so on Twitter you can find me it's at SYOUTH1, so it looks like SYouth1. So, and Twitter's been financial Twitter's been really great place to interact with folks, and I look forward to any chance that I have to interact with your viewers and listeners. But thanks so much for the opportunity to speak with you today and share my views. It's been a real privilege.
Fantastic, and thank you to our audience. Great, and we'll see you all next time.